So after reacting from this supply, the market started to move to the downside. And this move to the downside was totally efficient. Okay, what I mean by that is we left no imbalance along the way. This is the first supply. And as we can see, we had a sell-off, pullback, retest, leading us into the second supply, where we can see we had a sell-off, pullback, retest. That leads us into the third supply, where we can see here that we had this sell-off, pullback, retest. And it was around this point that I decided it was good to execute a move. This full range was efficient, so what does that mean? Well, it means that we don't actually have to go this high up with our stop. We can dial that in. And for this position, realistically, I could have actually dialed my stop to around this point, maybe even this point. But I opted to go a little bit safer, so I put my stop at 131.074. And that sits us just above this area here. And the reason that that's a safe place for a stop if we're selling this market is because due to the fact this range is efficient, there is actually no reason for us to hold the trade past this point. If the market gets this high, the likelihood of it actually reversing from here is very, very low. Almost as low as if we'd just taken this high out. So basically what we could do here is look to maximize the profits because we know if the market does go this high, we were wrong. There's no reason for us to half our risk reward and get stopped out up here. We may as well just cut the trade there and accept that we were wrong on this position. So by counting that efficiency, by looking at the supply, retest, supply, retest, supply, we can really get dialed in stops, which allows us to maximize the profit on the trades that we do take without putting stops in invalidated positions.